The broadcast is now starting. All attendees are in listen-only mode.
Okay, good afternoon, everybody, and happy Friday. Welcome to Wilkin and Gutton Plan's webinar titled Understanding the Paycheck Protection Program of the CARES Act, often called 3P. My name is Dan Fiorentino. I'm one of the partners here at Wilkin and Gutton Plan. I'm going to be moderating today's session. As you've probably seen in the news a lot is going on in the last week about this legislation that's come through. So we kind of figured it'd be a good idea to host a webinar at the end of the week, kind of recap everything that's come on and give you guys the latest information. Okay, today's presenters are going to be Bill McDivitt and Len Nitty, and as I said, I'll be moderating, so there I am in case you wonder what I look like. Just some general housekeeping before we jump into all of this. So the content of this webinar, it's based on the information available as of yesterday, actually. You know, there were some updates that came out last night around 8 o'clock, so we've incorporated all that. But this information is ongoing, and as new information is released, we have to modify certain interpretations. So everything that's in here, it's relevant as of right now, but that could change in a couple of days. We'll keep you up to date with the latest facts. If you have any questions while we're going through this, you should hopefully see the question pane in your GoToWebinar dashboard. You can submit that as we're going through all of this, but we're kind of just going to save those for the end at the back end. I think it's probably going to take about 40 minutes or so to get through the presentation, so hopefully that should leave us a decent amount of time, you know, to go through all those questions. And also, this webinar is being recorded and it'll be uploaded to our website. So if you like it so much, you want to check it out 3 more times later, help yourself. If you haven't actually been to our website yet, I would strongly recommend you check it out. We have a pretty good resource center on there for all of the COVID-19 special alerts that you need to check out. And it's just a really good way that you can stay in touch with the latest information. Okay, so before I hand this off, I just want to give you a little idea of what we'll be covering. For the first section, we're going to go through a general overview of the 3P. This is kind of just to get everyone on the same page so we have the basic underlying foundational facts that we need to move forward from there. From that, we're going to dive into the weeds a little bit and understand what goes into payroll costs. There's very specific guidelines on what is and what is not included. This comes into play later on when you're trying to calculate your loan amount. So you want to make sure you have a really good understanding of what's going into that. Like I said, that goes into our third section for the loans. On top of that, the fourth section, I think that's probably pretty high on everyone's minds, is that loan forgiveness. You know, it's one thing to get a loan that has good interest terms. It's a total different situation to get a loan that's forgiven. You know, is that really even a loan? And then the last section that we're going to go through is the loan application process. This is where we kind of dive into the weeds and we'll actually show you one of the forms that's been released so you get a better understanding of what to do with all this information and how you can move forward with your company. All right. So with that, I'm going to hand it over to Bill, and I'll let him start speaking.
Great. Thank you, Dan. So first, I want to say welcome to everybody. I'm guessing we've got about 350 people on the webinar so far. I'm guessing most of you are not in your offices, but instead you're in your homes. You're practicing the social distancing while we deal with the COVID-19 healthcare crisis. Dan said happy Friday, but you know, every day of the week seems like the same to me anymore. So I call this week 3, day 5. And that's just how I'm marking time. Week 3 of social distancing and being at home and working from home. I hope you and your family are safe and sound and that your businesses are okay. Many businesses we know are suffering mightily as a result of the need for social distancing and shutting down many businesses. Many businesses have gone to zero. Things like hotels and restaurants may not be at zero because they are able to have takeout, but many other businesses, retail and otherwise, have simply, you know, stopped earning revenue. The headline you see in front of you here now is a shocking and sobering headline. Over 10 million Americans applied for unemployment benefits in March.
Sorry about that, Bill.
Yep, that's better. Over 10 million Americans applied for unemployment benefits in March, and you know the economy is really struggling. So I'm sure, as many of you have heard, the government responded with a $2 trillion stimulus package. It was passed over the weekend, and hopefully, once this healthcare crisis subsides, whenever that may be, hopefully it's sooner rather than later, you know, I'm optimistic that we'll rise again and our demand will be where it was. Business was pretty healthy before we entered into this vortex, and hopefully we're going to come out well the other side. So this stimulus package, the $2 trillion stimulus package, is intended to build a bridge economically from here to there being when we're on the other side of the healthcare crisis. So we'll move on to the actual dates in the act. So things have been happening really fast. The law was passed last Saturday, and then April 1st, the SBA posted, the Treasury posted on its website the SBA's application and some frequently asked questions and information sheets. And then last night, as Dan mentioned, at about 8 o'clock at night, the SBA issued something called interim financial rules. I guess only the government can issue an interim final something, but interim final rules related to section 1102, which is the P3 loan section, and section 1106, which is the loan forgiveness section of the CARES Act. There are numerous conflicting guidance in the three information points you see above. The law was written quite late at night and in a short period of time. So the law itself, if that's all you had, has a number of inconsistencies in reference to itself. The form and the instructions for the form and the frequently asked questions have inconsistencies from the law. And what we got last night in the form of the interim final rules have inconsistencies with, in some cases, both the law and the instructions that have been provided. There have been a lot of advisors out there who have been attempting to interpret this stuff. It's a fast-moving target. Many of us have spent a lot of time with this. Sometimes we misinterpret things as we read it the first time, and it's very humbling to try to give people advice in this context of the information moving so quickly. And then there's, given the fact that this is, I call it the new toilet paper, everybody wants a PPP loan because it's forgivable, and no one, to my knowledge, has actually received one yet. People start passing around rumors and thoughts about what's happening. So it's a very, very difficult environment to perform in. And what I would say is, it's easy to, you can go back then, sorry. But I would say it's easy to pick on the legislatures and the SBA, but they're really well-meaning folks, who were stuck in the middle of trying to do this fast for the benefit of all of us in our economy. The SBA got this law and had to turn it around very quickly to make it administratively doable. Not picking on the SBA, but they're generally not a government body that's known for speed and efficiency. And they were basically asked to implement this law at warp speed, which is, you would expect there'd be some dots that are not connecting in that context. If we can move on. So we're going to clearly need some additional clarification on many things in this law. Certain aspects of the law need to be interpreted, and definitely see further regulations, specifically in the area of forgiveness. The law and the guidance that we have seen so far clearly indicates that we will absolutely get further guidance on forgiveness. And I think Len Nitty will be dealing with forgiveness later, but I think you will find that the forgiveness part of this is going to be a more onerous process in terms of the documentation necessary to obtain forgiveness. And then last but not least, just pointing out, which Dan had mentioned earlier, we are presenting this webinar based upon our current understanding and opinions as of this date. Who knows, at 4 o'clock tonight, we may get new guidance, and we'll have to start thinking about what that means as well. Okay, so what is a payroll protection program loan or a paycheck protection program loan? A lot of people refer to it as PPP or 3P or whatever acronym they choose to use. It's a federal program that authorized $349 billion of guaranteed loans, loans that are guaranteed by the federal government. Small and medium-sized businesses can receive the loans up to $10 million, and all loan proceeds could potentially be forgiven. So effectively, if it's forgiven, it's really not a loan, it's a grant from the government. There are no personal guarantees or collateral required. Normally, when you borrow from the SBA, you have to show that you've attempted to obtain credit elsewhere. And for the purposes of the P3 loans, this credit elsewhere requirement has been waived. And another unusual aspect of the SBA loan process with the P3 loans is that these loans will be received and applied for, and for that matter, forgiven at the banks. Normally, if you're going for an SBA loan, you would go to the SBA site, you'd make an application, you'd interact with the SBA. They may have someone fulfill the loan who's part of their banking network, but the initial point of contact on a regular loan with the SBA is typically with the SBA. This is completely different because the government wanted to try to move this money to the hands of business owners faster. So they thought that the way to do this is to allow the banks who are SBA approved lenders to do this, and other banks will be approved.
Okay. I see a lot of questions coming in on that. Actually, I just want to reiterate, go to your bank for this. This is not directly through the SBA. Go to your bank.
The thing I would say about the banks is today is the day that the doors are opened in theory on this program. What's happening is some banks are ready and some are not. Some banks are taking applications and some are not. And there seems to be a universal theme with the banks that are out there that they are only participating with a P3 loan with customers that are customers of the banks already, which kind of makes sense because the demand will be so high that that if you are trying to deal with non-customers, you're not going to be able to, as a bank, get to your existing and current customers, which makes a little sense, but it's problematic for someone who, for whatever reason, is not banking with or doesn't have a relationship with a bank that is going to be making these loans, and where do those businesses go to obtain access to P3 loans?
Okay.
So eligibility. How do we determine if a business is eligible? The rules are fairly straightforward and simple. The business cannot have more than 500 employees. And there's an affiliation rule we'll talk about a little bit more when we get to the application process, whereby if there's affiliated companies who, say 3 companies who have 200 employees each, and they are connected under the SBA's theory of what is an affiliated group, which is different than tax concepts. Those 3 companies with 200 employees each would be deemed to have 600 employees, and all 3 companies would not qualify. And the business must have been in business on February 15th, 2020. The business must have been making payroll payments. And the law allows for sole proprietors and independent contractors and other self-employed individuals to also apply for P3 loans. We'll talk about this a little bit more in a bit, but there's a lot of confusion about sole proprietors, independent contractors, and other self-employed individuals. But what is absolutely clear in the guidance now is that these businesses can also apply for and obtain P3 loans. And then to the extent you're a nonprofit or any of these other organizations that are listed, you can also qualify for a P3 loan.
Now, Bill, to become eligible, do you need to actually prove economic damage on there, or is there some type of presumption?
Can you advance the slide, please?
Oh, sorry. We're all working from home here, guys. Give me one sec for my computer to catch up.
Okay. So we need to understand, because payroll costs drive the amount of a loan that you could qualify for, we need to have some clarity about what these payroll costs are. And within the new law, it's enumerated, and within the guidance, it's further enumerated and sometimes inconsistently with the law. And these payroll costs serve as the basis for calculating the maximum loan, as we'll see in a second. So this is literally from the law. It says the term payroll cost means the sum of payments of any compensation with respect to employees that is and then I'll focus on the top line and the bottom 3 lines, and the middle few I'll step around. But the first bullet says salary, wage, commission, or other similar compensation. We read this to mean gross salary, and we'll explain that in a little more detail later when you're calculating what you qualify for. Also, skipping down to the third from the bottom, you would add to salaries any employer portion of costs that are incurred for group health benefits, including insurance premiums. Also added to this amount is any employer payment of any costs related to a retirement benefit. And last but not least, what would be added to these costs is payment of state or local taxes that are assessed on the employer for the compensation of employees. So in the state of New Jersey, this would be unemployment and disability types of payments. And then slip the slide. So here's where we get into an area of that has not been well understood, in part because the way that the wording of the law was and the guidance that came was a bit clumsy. What we got last night was a little bit of clarity as it relates to this, but what I'll do is I'll just read what's here. And it says the term payroll costs also includes the sum of payments of any compensation to or income of a sole proprietor or independent contractor that is a wage, commission, net income, net earnings from self-employment, or similar compensation that is in an amount not more than $100,000 in 1 year as prorated for the covered period. And then we say this is what the law says. So when we read the further guidance we've gotten, the implication is that this created a window for independent contractors to make their own claims for P3 loans. And what was clear in the guidance that we got last night, and you see on the slide here, the guidance we got last night in the interim final rules state that payments to independent contractors, this is by an employer, do not qualify. And it says do independent, and literally in the document, we cut and paste this from the document, do independent contractors count as employees for purposes of a P3 loan calculation? And the answer is no. Independent contractors have the ability to apply for a P3 loan on their own, so they don't count for purposes of a borrower's P3 loan. And this, when they issued this clarity, it kind of makes sense, because if an employer was counting an independent contractor and then the independent contractor could count themselves, there'd be a double dip for that individual. So, and initially, I think, certainly we thought, and I think others did, initially when we only had the law, we thought that employers would be able to pick up income for payments that they made to independent contractors. And now the interim final rules have more or less clearly determined that they do not qualify for purposes of calculating the average monthly payroll.
Hey, Bill, I think one thing on a lot of people's minds is in regards to guaranteed payments, and if
Next
the law
slide,
gave any
please.
guidance for that. Can you hear me, Bill?
Okay, so what is included in payroll costs? I'm sorry, what is not included in payroll costs? So the first bullet has been a real controversy. Basically says the compensation of an individual employee in excess of annual salary of $100,000 is prorated for the covered period. So what does that mean? And scroll back one slide, please. Two slides, I'm sorry. 3, sorry. So what does that mean? We read it to mean that bullet A is limited to $100,000, just the salary. And that, when I said bullet A, but I meant the first bullet. If you go down to the third from the bottom bullet, second from the bottom, and the last bullet, we believe that based on current guidance, that in addition to that $100,000 salary, there is the ability to add the portion of group healthcare benefits that are attributable to that individual and any retirement benefits that are paid that are attributable to that individual, and any payment of state or local taxes, which again is mostly a small amount of SUI and disability, would also be attributable to that individual and allowed. So that an individual who's making, say, $150,000 would have their salary capped at 100, and then would have, say, $20,000 added for health insurance, $10,000 added for retirement benefits, and $500 added for state and local taxes. And this has been an issue that has been troubling folks as to whether that $100,000 cap was a cap on all of those things combined, or if it was additive. The other thing, and you might go forward to the slide we were on, Dan, with the, so the other question that has been out there is, I think people mistakenly assume that they read this $100,000 rule, they assume that anyone who was making over 100 didn't count. And it's quite clear that they do count, they're just capped at 100. And while we're on it, sometimes people think that owners who are drawing salaries might not count for this purpose, and there's nothing excluding an owner who takes a paycheck from also being included in this calculation. This next bullet has really been a thorny one. It talks about not including taxes imposed or withheld under chapters 21, 22, or 24 of the Internal Revenue Code. 21 is FICA, 22 is the old Railroad Benefits Program, and 24 is income tax withholding. So some folks read this to mean that you had to take salary and then subtract these things from salary and in effect make your calculation based on net income. We believe, is our opinion, and we believe the guidance that's currently out supports this opinion, that you would calculate the average monthly payroll using gross salary and not net these items. In some of the guidance that we got last night, they made clear that for calendar year 2019 through February 14th, 2020, that you would not have to subtract anything for taxes or withholding under this provision. And I think that's the main points here on this slide. So then what happens once we calculate, how do we get to the total loan amount? So the statute says that it's 2.5 times the average total monthly payments by the applicant for payroll costs incurred during the 1-year period before the date on which the loan is made. So that is literally the law. When we first read this, our assumption was if we're going to get a loan on April 1st, what we'd be counting is the second, third, fourth quarters of 2019, and we would be adding the first quarter of 2020, because that would be the 1-year period before the date on which the loan is made. The form for the application, the instructions for the form for the application, and the guidance we received last night make it clear and state that it is okay to use calendar 2019. And in fact, the instructions say most businesses will in fact use 2019. And if you're using 2019 for your average total monthly payments, then you absolutely would be using gross pay, not net. And this has been a controversy that's been out in the marketplace. One of the national payroll providers has come out recently in the last, I'm going to say 2 or 3 days, and issued reports that showed net, not gross salaries in connection with calculating this. So that caused most of the advisors in the world to pause and really reflect on this. I have to confess, prior to that payroll company coming out with that information, we didn't even think about using a net for this calculation. But after they did, we said, you know, they're big, they must know something that we don't know. We went back and looked. And even after we went back and looked, we felt confident that the way the law is written, while there were 2 ways to read the law, the gross was a gross reading of the law, meaning gross payroll was an appropriate reading. And we've now received since clarification in the instructions to the form as well as the guidance we got last night, that 2019 period would be gross, not net, for purposes of calculating the total monthly average. So now I have the total monthly average payments. Let's say for the sake of discussion, it's $1 million. I multiply that number by 2.5, and that taxpayer would qualify for a $2.5 million loan, which is lower than the 10 million because 10 million is the max. So that taxpayer would qualify for a $2.5 million loan.
Okay.
All right,
Okay.
before we talk
Now
about
we're
loan
going to turn
forgiveness,
this over to Len Nitti, who is going to walk you through how you get a loan forgiven.
Okay, I think some quick housekeeping, Len. I'm getting some messages from the audio. I think we might have an issue with Bill's audio. Len, can you hear me loud and clear?
I hear you fine, Dan.
Len?
Okay, perfect.
So, you know, to go back, and you did ask one question, Bill, that I don't think got answered, and I do want to handle that one before talking about loan forgiveness. In that, what about
technical difficulty here?
What about partners and partnerships? What about their guaranteed payments and their earnings from self-employment income? Our interpretation of the law is that, unfortunately, those types of payments are excluded. They're not included in here. We understand it does create an inequity, since owners of an S corporation can pay themselves salary and be included, as well as sole proprietors and other self-employed individuals. For some reason, this was not included in the law. It may have been an oversight. Our understanding is that Congress is aware of this, and should there be another round of relief in the near future, that they would likely address it under that scenario. So what about loan forgiveness? How do we have this loan forgiven? And essentially, the clock starts ticking when the loan is originated and you receive the proceeds from the loan. And the law gives you an 8-week covered period beginning on that date. And to the extent that you're using the proceeds for qualifying expenses, you're able to have, or you qualify to have, all or a portion of the debt forgiven. And what are those qualifying costs? You have payroll costs as defined in the Act, which Bill went through. Costs relating to the continuation of group health care benefits during periods of paid sick, medical, or family leave. Mortgage interest payments, as long as the mortgage was in place as of February 15th. Same for rent payments, as long as the rental agreement was in place as of February 15th. Utility payments, and also interest payments on any other debt obligations that were incurred before February 15th, 2020. Now, where it gets a little interesting and possibly challenging on the forgiveness is the way that the interim final rule was written when it comes to how these proceeds can be spent and what can be forgiven. The interim final rule says that no more than 25% of the loan can be forgiven for costs outside of payroll. So all of the rent, mortgage interest, and anything else that's being paid, you can't get forgiveness for any amounts that exceed 25% of the loan that you were given. It further says that a minimum of 75%, and I'll read exactly what's in the final interim guidance, is at least 75% of the P3 loan proceeds must be used for payroll costs. This is where, you know, the way things are defined within the law is a little challenging. And as Bill explained, you're looking at gross payroll for purposes of calculating these loans. But the way that the law and the guidance defines payroll costs, it says that it doesn't include, for the covered period, which is the 8 weeks following getting the loan, any amounts paid or withheld for Social Security or withholdings for federal income tax. So it's moving you to a net amount for payroll costs. If you have to spend at least 75% on qualifying payroll costs for the loan to be forgiven, I'm not quite sure how you could get there, because 8 weeks over the 2.5-month period that they're giving you, it's about 74 to 75% of the cost of the loan that you can get. And that's based on gross payroll. So if they're only going to give you credit for payroll costs on a net basis, which is what the law says, you're going to fall short of 75% unless you effectively give everyone raises. So we're going to see how that develops, and hopefully they will revise that guidance and fix that issue that we see. But more to be determined here, as they did say they're going to give substantially more information in terms of how to deal with forgiveness in the coming weeks and month ahead.
Okay, hey Len, on that, so I know the calculation can get a little bit complicated with that 75%. So just to make sure I'm paraphrasing this correctly, it would appear that the calculation is suggested to be based off of a gross number. Otherwise, the math wouldn't seem to work as much for a net amount. Is that accurate?
Correct. Or they have to rethink the 75% that they put in the interim final guidance, because there's no reference of percentages within the law itself. They've made this determination by doing simple math that, if you take 8 weeks of payroll over the 2.5-month period, it puts you to 74% and change, and they're rounding it to 75%. I don't think they picked up on the fact in how payroll costs were defined differently for purposes of obtaining the loan and then calculating it during the covered period. So
Gotcha.
Hopefully we get a fix there, and these loans, there won't be a hiccup when taxpayers go to have these loans forgiven.
Okay, I'll move you on.
Go ahead. So there's...
Sorry, lag on my internet here.
No worries, Dan. It's a challenge for everyone, I'm sure, as everyone is remote. These are the new times we're dealing with. But there's also provisions that they've put in to require you maintain the headcount that you had before and after you obtain these loans, and also for the amount of wages that you're paying everybody. So in terms of headcount, what it says is you have to look at your average full-time equivalent employees per month during the 8-week period beginning on the loan origination date, which is your covered period. That's when you're going to be paying out employees' wages and payroll costs. And then you have the choice of using the denominator in one of two ways: either average full-time employees for the period beginning February 15th, 2019 and ending on June 30, 2019, or you may use the full-time equivalent employees per month during the period beginning on January 1st, 2020 and February 29th, 2020.
So Len, with that, do you want to elaborate a little about what the options would be and why you'd want to pick one over the other?
Yeah, from my perspective, you would go through both calculations and understand what your average full-time employees are for both of these periods, and whichever results in the lesser number is what you're going to want to choose, because that's how you're going to maximize the benefits here and reduce the possibility of having a proportional amount of your forgiveness reduced for not maintaining the same headcount. I think this is going to be a more challenging thing for businesses that have had to close the doors and may have sent all of their employees already to the unemployment line. It may not be quite as easy to get all of them back to start paying them again and get them to give up the unemployment benefits. It'll be easier for the businesses that are able to continue operations to meet these tests.
Gotcha.
So you can move forward to the next slide.
Yep, I clicked it, just waiting for it to move, sorry.
Okay. So the other concept, and here we are with the slide, is you also can't reduce salaries for most employees or certain employees. And what they're saying is you're potentially going to have a reduction in the amount available to be forgiven if certain employees have their comp reduced in excess of 25% during the covered period compared to where they were in the most recent full quarter during which the employee was employed before the covered period. So, one it's going to be challenging based on the 75% rule that they put in the interim final regs, because they're requiring that at least 75% of the PPP loan proceeds be used for payroll costs. So it's almost suggesting there that you can't have a reduction of payroll costs and still meet the eligibility requirements, even though this rule is saying you are allowed to reduce employee comp by not more than 25%. There is an exclusion here in that you are able to reduce the comp by more than 25% for employees who are earning more than $100,000 annually during any period during 2019. So these are a little confusing to go through because, but you'll need to pay attention to these on the back end, and hopefully the government gives us clear examples and clear guidance so that taxpayers aren't impacted here negatively. And in terms of those two limitations on how much of the loan can be forgiven, there's also an exception to the rule. And essentially what it tells us is, if the eligible employer has eliminated the reduction in the number of average full-time equivalent employees by June 30th, 2020, that first rule is not going to apply. And also, if the eligible employer has eliminated the reduction in salary or wages of such employees by June 30 as well, that's not going to be an issue either. So you wouldn't have to worry about these two phase-out provisions within the law, as long as you get everyone back up to speed in terms of headcount and also pay by June 30 of 2020. So it does create some flexibility within there for businesses that have been severely impacted, especially those that have needed to close their doors as part of this whole pandemic.
So Len, is that basically giving them a cushion? Like if I were to get the 3P loan, the proceeds in 3 weeks, I don't need the next day to bring everyone back. I have a little bit of breathing room for this deadline. Is that correct?
Correct. Absolutely. Just keep in mind that you do have to spend the proceeds within that 8-week covered period to qualify for any level of forgiveness. Because to the extent that you don't expend those proceeds within the 8-week coverage period, that amount would not be forgiven. So, give you an example. Say that you received $1 million loan under the P3, and you only incurred $800,000 of qualifying expenses during the coverage period. $800,000 of the loan could qualify for forgiveness, and $200,000 would become a term loan termed out at 2 years at a 1% interest rate.
Gotcha.
Hopefully that example helps clarify it a bit.
Okay.
So in order to request forgiveness, this is what we currently know in terms of documentation that's going to have to be provided to the lender. You're going to have to provide documentation to verify the number of full-time equivalent employees and pay rates, payments on eligible mortgage, lease, and utility obligations. You must certify that the documents are true, and the lender must make a decision on forgiveness within 60 days of receiving the documentation from you. Also important to note, very, very generous in this law in that for federal income tax purposes, the amount of the debt forgiveness shall be included from gross income for income tax purposes. So normally when you would have a debt forgiven, you would be subject to cancellation of indebtedness income. Under this law, however, this particular type of indebtedness forgiveness is excluded from having to pay tax on.
You said that's for federal. What about state?
So for the states, we're going to have to wait and see how they react to that and whether or not they're going to be on board. For New Jersey purposes, at least from a gross income tax perspective, as opposed to a corporate income tax perspective, cancellation of indebtedness income is not taxable anyway, so they should be fine if they're a sole proprietor or are a partner in a partnership or a partner in an LLC. We'll have to see how New Jersey interprets this from a corporate business tax perspective. And I think for a lot of the other states, we'll have a wait and see approach also, although many of them do follow federal tax principles, So I could see many also allowing for this loan forgiveness to not be taxable as well.
Gotcha.
So if the loan is not forgiven, the interest rate I think I mentioned is 1%, and the loan is due in 2 years. To the extent that the loan is forgiven on principal, you don't have to pay the interest associated with that principal forgiven. That is also forgiven. Payments are deferred for making repayments on the loans for 6 months, although the interest will still accrue for any amount of the loan not forgiven. And there are no pre-penalties or fees associated with these loans. So that's a bonus as well, where if a taxpayer wanted to pay it off immediately, once they get through the covered period, they could do so without penalty.
Gotcha. Okay. So I think the next part, we're going to hand it over to Bill. We're going to just check the audio on that. Bill, are you with us still?
Yeah, everything's okay now. I apologize to you, Dan, and to the audience. I'm guessing you were talking to me and I wasn't hearing you.
Possibly.
I apologize for that to everybody. I could blame it on some technological glitch, but as often is the case with me, it was a user issue. And I'm home and don't have direct tech support over my shoulder, so I triaged and fixed my own computer issue. I apologize for that.
No problem at all. Happy to have you back. Do you hear me fine now?
I can hear you fine now, Dan.
Perfect. All right, let's push through.
So let's talk about the loan application process. So the Treasury website has posted on its website information that says that today is the day that small businesses and sole proprietorships can apply to receive loans through the SBA. And as we mentioned earlier, some banks aren't ready to receive these loans applications. Some banks are, but I think it's going to be a process that's going to take some time before the banks can digest what it is they need to do and get the money out to businesses. On April 10th, independent contractors and self-employed individuals can apply to receive loans. And other lenders will be able to make loans as soon as they're approved and enrolled in the program, other than SBA lenders. Everyone who is FDIC insured who might not have otherwise been an SBA lender will be authorized to make P3 loans in this situation.
And does it seem like a lot of banks are online with this today, Bill, or are you hearing that most still need some more time?
Yeah, it's a mixed bag. I think I would say most need more time. A few are taking applications today. The applications they're taking are just the form itself. They're not taking any documentation. So presumably they're still getting their ducks in a line, even those that are taking applications today. So time will tell when money actually moves into the hands of the business owners. Okay, so this is the loan application. This is the whole thing. And we know you can't read it, and we're going to zoom in on this form in a second. But we just wanted to show folks who might not have seen the loan application how simple it is. It's only 2 pages. There's not a lot of data, not a lot of info that has to be responded to. I think the instructions say you can complete it in 8 minutes, but I think you'd have to be pretty nimble to complete this in 8 minutes. It might take you a half hour to an hour. And certainly calculating the average monthly payroll will take you some time. The thing I want to mention about the application that's very important is, to the extent someone pulled an application from the Treasury site before last night, you need to go back to the Treasury site, because this is a new form that was posted only last night. And the form that was posted last night is the only form you should be using in connection with making an application for a loan. So this is zoomed in on page 1, the top of the form. And as you can see, there's not a lot of data that's necessary here. Some basic information about the business, basic communication information, email, primary contact, phone, tax ID number. And I think this part of needing so little information here is most banks are only dealing with their existing customers. So given that they already have a relationship with these customers, they don't need an awful lot of data. Bottom left, the big rectangle box, to the left it says average monthly payroll. To me, this is the most important box on this form. This is the number that's going to drive how much you qualify for a loan. And then if you move to the right, you multiply that number by 2.5 times, and that's the amount that you would qualify for a P3 loan, assuming you don't have an EIDL loan that you're rolling into this. So we highlighted a section of this part. This is where we get into describing who the owners of the business are. There are a number of questions that are here that are mostly straightforward and easy to answer. Question 3 we highlighted because this is the question that identifies affiliates under the SBA's affiliation rule concept, whereby for all affiliates of the business you're applying for, you would have to consider the employees of the affiliated businesses to determine whether you're under 500. I made the example before of, say you have a single owner who owns 3 businesses and they each have 200 employees. If that was the case, here on question 3, we would identify that there are affiliates, and then we would describe those relationships on a separate addendum. And we would also have to identify that we had 200 employees in each entity. And given that fact pattern, none of the 3 companies would qualify for a loan because together in the aggregate, they have 600 employees, and that exceeds the 500 allowable.
So, Bill, is this kind of like the catch that would get a lot of companies owned by private equity groups, then, you think?
Yeah, there's been a lot of discussion about that because many people are familiar with affiliation rules or common ownership rules, or however you want to describe it, under numerous tax concepts that are out there. And most often those rules require either a 50% ownership or an 80% ownership, depending upon what type of statute you're under in the tax law. But in the SBA's eyes, if you read the description there, it's common management also causes you to be affiliated. And with the private equity companies, very often, even if the private equity company does not have a majority ownership of the company, they will have a say in management. If they have a say in management in company A, and they also have in their portfolio 6 other companies, those 7 companies will have to be added together for purposes of determining whether or not the single business has more than 500 employees. I know for a fact that the tech world and the PE world is lobbying heavily to fix this provision to make it more of a majority control kind of a provision. Whether or not they're going to be successful, only time will tell. Okay, so here we're getting into identifying who owns more than 20% of the company. I'm sorry, these are the bad boy provisions, 5 and 6. So this is if someone had a problem with the government and had any criminal charges or other kinds of felonies or problems previously with the SBA. If you do, you would be out for this loan. Also listed here is that you need the principal place of business of all employees needs to be in the United States. Okay, so this is an important page, and we tried to blow it up as much as possible. This is the certification that folks who are signing the form have to certify to. And there's some surprising elements on this certification. One is if you go down to the third from the bottom, that you have to say that to the extent feasible, you will only purchase American-made goods. Dan, are you talking? Because I can't hear you if you are.
I'm not talking. I can talk now.
It's been so long since you were silent, I wanted to just check that point. So all of these things have to be signed. And the other one I wanted to point out is the fourth from the bottom, that the SBA loan proceeds will be used only for the business purpose. It can't be used for personal purposes. So move forward.
Okay. Sorry, Bill, working on it here.
That's all right. I've had my fair share of user problems.
There we go. All
Yeah.
right, you all set, Bill?
These are further certifications that the owners must make. And the most significant one, and the one that's gotten a lot of attention, is the second one. And it says, current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. Well, if I'm a hotel operator and I'm closed, I can easily check that box. If I am a medical practice and I can't open, I can easily check that box. If I'm a restaurant and I'm only doing takeout now and my business went to about 5 or 10% of what it was previously, I can easily check that box. But for some businesses, they're impaired, but they are not necessarily as wounded as those more significantly wounded businesses I just described. And what the SBA is saying and what the statute says is there is a presumption that all businesses have been adversely affected by the COVID crisis. So therefore, checking this box is an automatic for every business.
Nope. Sorry, sneak preview, guys.
Yeah. So this is cut and pasted from the interim final rule that we got last night, which is saying, what does the bank have to do to underwrite these loans? And there's more information there, which there were some technical banking issues that we didn't cut and paste. But basically, as it relates to the information that a customer would be providing to the bank, it's basically the SBA form, which is the application form that you'll get off the the treasury.gov site, and supporting payroll documentation to establish eligibility, and secondarily to support the average monthly payroll. And then to the extent borrowers don't have this documentation, they can use other documentation other than payroll tax returns, et cetera. I would think most people would have these forms available.
Okay, I think that brings us to the end of this part. Since we are running short on time, I think maybe we can open this up for a couple questions that I'll pass along to you guys, and then Bill, you can do your closing remarks. Just going down the line here, one participant asked, are PEO costs eligible for this program if they're doing their payroll through that? So
that's a very, very good question. There is nothing explicit in the CARES Act law, the application and the frequently asked questions, and the guidance that was provided last night that speaks specifically to PEOs. However, in most other circumstances in recent history where employer-employee relationships were important, example is in the tax world 199A, and there are other examples. In recent history, the government has more universally accepted the fact that the business that's economically paying for those employees and utilizing their services is in fact the employer. So it's our opinion that a PEO arrangement would qualify as wages for the employer who's paying the PEO for those employees.
Okay, very good. Another question on here, and actually I think you had mentioned this before, but just to reiterate that, can you repeat the $100,000 interpretation limit on here? We had a couple people ask that again, actually.
This has been another hot one, so it's worth talking about again. The limit of $100,000 is, from our perception and the guidance that we've gotten, seems to be clear that it's only on the element of salary, and that for someone who is making, I think I made the example, $150,000, you would count that person's salary for 100, and to the extent they had a healthcare benefit employer for 20, you would count the 20 on top of the 100, and to the extent they had a retirement benefit of 10, you would count that 10 on top of the 120. So for that individual employee, in effect, they would have $130,000 of costs, salary at 100, healthcare at 20, and retirement at 10 that would go into calculating the average monthly payroll.
Okay. We had mentioned that the loans are going to be forgiven. What about the interest portion? Does the law specify anything on that?
To the extent that the principal is forgiven, that portion of the interest will be forgiven as well. To the extent that the principal remains in place, interest is accruing at a rate of 1% per year.
Gotcha. Okay. When does this program run through? Like, how long do they have to apply for this?
Well, the information that we got last night says that that it starts today, and it's a first come, first served basis. And there's a concern in the marketplace that there's going to be more demand for these loans than there is supply. $350 billion sounds like it's an insurmountable amount of money, but if you think about the number of businesses that may be requesting this kind of support, it wouldn't shock me if in a couple of weeks we had hit that limit. I believe formally you can apply as late as June 30th, but in light of what I've previously said, my expectation would be that by June 30th, the entire allocation would have been long gone. So we're encouraging our clients to get to the banks, let them know you want to apply if they're not ready to receive an application. If they are ready to receive an application, we're suggesting that you submit them as soon as possible.
Okay, one more quick question on here. I know, Len, you had elaborated before about guaranteed payments. What about S corporations if they have officers' compensation? Is that allowed? Len or Bill?
Yes, wages paid to an employee shareholder would qualify under the law, subject to the $100,000 cap.
Gotcha. Okay, very good. Any suggestions on how they can track these expenses? Like they're going to need to support documentation supporting when they go for forgiveness. You know, do you have any recommendations on how they can track that?
Yeah, money's fungible. So if a company took these loan proceeds and dropped it in their checking account, it's mixed in with all the expenses, which I don't think is necessarily a problem because you'll later be able to prove that what you spent it on, salaries and rent and utilities and other qualified costs. But some of my clients have been thinking about setting up a separate bank account that will only receive these proceeds and only pay qualified expenses, so that every deposit and every expenditure from those accounts will be 100% relatable to either the obtaining of the loan or the forgiveness documentation of the forgiveness, which I think is a good policy.
Gotcha. Okay. Since we are running low on time, I think we're going to have to cut the questions there, unfortunately. I think, Bill, you had a couple closing remarks for the audience.
Yeah, I just wanted to thank everybody, for coming and listening to us. It's a really confusing circumstance that we're all in. We're trying to figure it out as best we can as we go along. We hope that this healthcare crisis will be over soon. It is really distressing to not know when the end is. I mean, as we sit here today, if we thought the end was April 30th, it would be a completely different matrix than if we thought the end was July 31st. But the truth is, none of us knows when the end is. We hope it comes soon and we can all get back to normal life and also equally importantly, get back to business as usual. And hopefully these loans, P3 loans and other stimulus elements from the government will help businesses bridge the gap from here to there. As Dan mentioned earlier, if you want to hear a replay or if you want to suggest that someone who didn't hear this listen to it, you'll see it on our website. It'll probably be up later today. And if you need any further information, we have, as Dan mentioned earlier, a COVID resource center where we have information on a variety of topics listed there, and we continually add to that to keep it current. And last but not least, if you folks need any help in trying to deal with this P3 loan or anything else that you're wrestling with during these troubling times, reach out to any one of us or anyone at the firm. Would be happy to help you. And with that, I will say have a good afternoon.
Thank you, everyone, for attending today.